Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing out there? If you don't know who we are, shame on you, but jazzwealth.com, check us out there. Hey, we're going to dive into something a little different here. It's a class that I shared with customers. Every Thursday we do a class for customers, and I'm just going to dive right into it, keep this short for you. You know the average stock market return, 7% that they say. It's actually 9.8, but they say 7.7%. Well, one thing that happens is people start to get in their minds that 7% is what I should expect. But in fact, that almost never happens. So I want to share that data with you to get your mind right in case this year's a little bit different. You're taught 7%, just buy and hold. You'll get a 7% average, but in fact, there's almost no time where you see that happen. 49.4% of the time, just about half, the stock market actually returns less than 7%. So we did a class for customers to break it down and say, well, how often do you get these different returns? What are the distribution of those returns in the stock market so that we know not to expect 7% or really anywhere near it on a year-by-year basis? So here we go, highlighted in red, 6.7% of the time the market returns between 5 and 10%. This is over the last 100 years. So we normally don't see that, but yet we expect it. So we're either really happy or really dissatisfied with the market's results. We're almost never right there smack in the average. It's kind of odd, right? The stock market actually likes to return plus or minus. Think of it as the stock market acts in extremes. It goes extreme to the upside, extreme to the downside, and on its way, the calendar hits every now and then, and we close out the year with a sort of a small gain. 9% of the time, 0 to 5% is where we land. 7% of the time, 5 to 10%. You can see as you work your way up here, you find that the stock market likes to have really large gains, and as you work your way down, it likes to have really large losses. So that's the stock market in a nutshell. It's moving between extremes, but how long it takes maybe depends on the calendar and what happens there. All right, so you say, well, that's over the last 100 years. Maybe let's take it a little bit further. Let's see if those stats apply over a lifetime of somebody saving for retirement. Does the same thing happen? So here we go. We've got from 2020 all the way back to 1990. So you got 2020 down to 2005. Shift over to the right. We carried it forward all the way to 1990. What we did is color-coded them to show you how often in that time period the stock market actually returned the different averages. So 0 to 5%, 13% of the time. 5 to 10%, 6.7% of the time. That's the average, right? It's only twice. So in 2007, basically average. 1992, basically average. How many times did we just say that that was going to happen? 6.7% of the time over the last 100 years. Over the last 30 years, it's exactly 6.7% of the time. 10 to 15% and further, you start seeing that there's a higher probability that you're going to have larger gains. That's why they always say you don't try to time the market, right? Because if you miss out on one of those big years, well, it's really difficult to catch up. So you want to, obviously be a part of that. You look through the whole pre-dot-com era there. We had these year after year after year of massive gains in the S&P, by the way. This is not the NASDAQ or anything else. Big gains followed by sort of odd declines and then a large decline there, right? 6.7% of the time we fall 20% or more. And so you would say, if that happens multiple years in a row, is that not a buying opportunity? Would you not want to be a part of that? Because odds are it's not going to continue going forward. It's the same thing with the average gains. If you have an average gain in the stock market, don't you know we're headed towards one direction or the other. So if the stock market had a great year and then started to drift back down and finished average, are we not maybe swinging in the other way? It's a really simplistic way of looking at it, but there you go. How often the stock market loses 0 to 5%? Almost never. 6.7% of the time. 1990 you had there, and 2018 was essentially a flat year. We all kind of wrote it off as flat there. Down 5% to 10%. Only 3% of the time. You could look up at the chart below to try to find it there. It's only once. Can you find it? Ta-da! 2000. That was it. Minus 9% set us up for a whole lot of nastiness going forward, but that's what you have there. So the bottom line is the average return is not actually average. It just doesn't happen all that often. So if we were to have a string of years where the average return was less than 7%, you would think we're on our way towards bouncing towards the other extreme. There's a few ways to look at it, but I just wanted you guys to think of how to get your mind right around not expecting 5 to 10% gains in a year. It's actually not that common. Well, hey, if this helped you, if this was interesting to you, it took us a little bit of time to put it together. Maybe you'll take a second and hit the subscribe button. I'm supposed to ask. Just go ahead and hit the button, please. Helps us out. We're almost to 100,000 subscribers. Hopefully, by the time you watch this, we're at 100,000 subscribers. We'll see what happens.